There's a financial mistake retirees are making right now, and it starts with paying off their house. It feels like security, but it can trigger tax consequences most people never see coming. And once it happens, there's no easy way to undo it. The IRS isn't warning you about this, but you need to know. Let me walk you through exactly how carrying a mortgage into retirement creates a hidden tax trap that almost no retiree sees coming. Start with a retiree named Richard. Richard is 68 years old. He retired 2 years ago. His monthly expenses are $4,200. His income comes from 3 sources: $1,800 per month in Social Security, $900 per month in pension income, and whatever he withdraws from his traditional IRA to cover the rest. Richard still has a mortgage. His monthly payment is $1,100. That $1,100 mortgage payment is part of his $4,200 in monthly expenses. To cover $4,200 in monthly expenses, Richard needs $4,200 in monthly income. Social Security covers $1,800. Pension covers $900. That leaves $1,500 per month that must come from the IRA. Annual IRA withdrawal, $18,000. Now add his income together. Social Security, $21,600. Pension, $10,800. IRA distribution, $18,000. Total gross income, $5,400. Now apply the Social Security provisional income formula. Provisional income equals adjusted gross income plus non-taxable interest plus half of Social Security. In Richard's case, $28,800 in non-Social Security income plus $10,800, which is half of his $21,600 Social Security. Provisional income, $39,600. That puts Richard above the $34,000 threshold for single filers, where up to 85% of Social Security becomes taxable. 85% of $21,600 is $18,360 in taxable Social Security income. Richard's total taxable income, $28,800 plus $18,360 equals $47,160. After the standard deduction for a single filer over 65 in 2026, which is $16,550, his taxable income is $30,610. Federal income tax on that amount at current brackets is approximately $3,450. Now remove the mortgage. Same Richard, same retirement. Paid off the house 2 years before retiring. His monthly expenses are now $3,100, the $4,200 minus the $1,100 mortgage payment. To cover $3,100 in monthly expenses, he needs $3,100 in monthly income. Social Security covers $1,800. Pension covers $900. That leaves $400 per month from the IRA. Annual IRA withdrawal, $4,800. Total income, Social Security $21,600, pension $10,800, IRA $4,800. Total $37,200. Provisional income $15,600 in non-Social Security income plus $10,800 half of Social Security. Total $26,400, below the $25,000 threshold for single filers. 0% of Richard's Social Security is taxable. Total taxable income, $10,800 in pension income plus $4,800 in IRA distributions equals $15,600. After the standard deduction, negative $950. Richard owes 0 federal income tax. Same person, same retirement, same Social Security, same pension, same IRA balance. The only variable is the mortgage. With the mortgage, Richard pays $3,250 in federal income tax per year and has 85% of his Social Security benefit counted as taxable income. Without the mortgage, Richard pays 0 federal income tax and 0% of his Social Security is taxable. Over a 20-year retirement, that difference, conservatively, is $69,000 in federal tax savings. Not counting the Medicare IRMA A implications. Not counting the compounding effect of keeping that money in the IRA. Not counting state income taxes in the 41 states that tax retirement income. That is the mortgage tax trap. That is why the IRS, mathematically structurally, through the interaction of the tax code's own formulas, benefits when retirees carry mortgages. Because a retiree with a mortgage needs more IRA income. More IRA income means more taxable events. More taxable events means more revenue for the federal government. The retiree who pays off the house before retirement removes herself from that cycle entirely. Now let me walk you through the Medicare piece of this, because this is the layer that almost no retiree has been told about, and it makes the numbers even more dramatic. IRMA stands for Income-Related Monthly Adjustment Amount. It is the surcharge the federal government adds to your Medicare Part B and Part D premiums when your income exceeds certain thresholds. In 2026, the base Medicare Part B premium is $185 per month. If your income is below $103,000 as a single filer, that is what you pay. But if your income exceeds $103,000, your Part B premium jumps to $259 per month. If it exceeds $129,000, it jumps to $370. The surcharges go up in tiers all the way to $594 per month for the highest income retirees. Here is the part almost no retiree understands. IRMA is calculated on a 2-year look-back. The Medicare premium you pay in 2026 is based on your 2024 tax return income, which means that a decision you made in 2024 about how much to withdraw from your IRA is directly determining what you pay for Medicare right now in 2026. A retiree who carries a mortgage into retirement and withdraws an extra $1,300 to $200 per year from their IRA to cover the payment, which is exactly what happens with a $100 per month mortgage, may push their income across the $103,000 IRMA threshold. That triggers an additional $74 per month in Medicare Part B premiums, $888 per year, plus Part D surcharges. For a couple filing jointly with 2 Medicare enrollees, the combined IRMA surcharge can reach $1,776 per year or higher. That is the IRMA trap inside the mortgage trap. The mortgage forces the IRA withdrawal. The IRA withdrawal inflates the income figure. The inflated income figure triggers the IRMA surcharge 2 years later. And the surcharge continues for as long as the income figure remains elevated, which is as long as the mortgage remains active. A retiree who eliminates the mortgage before retirement eliminates the excess IRA withdrawal, eliminates the income inflation, eliminates the IRMA trigger, and locks in the base Medicare premium for as long as their income stays below the threshold. For a couple in retirement over 20 years, the combined IRMA savings from eliminating a mortgage-driven income inflation can exceed $35,000. Combined with the income tax savings I described in Part 3, the total financial benefit of paying off the house before retirement for the median American retiree is between $80,000 and $120,000 over a 20-year retirement period. Almost no retiree has been told that number. Almost no financial advisor has run that specific calculation for their clients. And the retirees who understand it before they retire are the retirees who make a different decision about their mortgage, while they still have time to make it. Now let me walk you through the counter-argument, because you have probably heard it, and it sounds reasonable until you look at the actual numbers. The counter-argument goes like this. My mortgage interest rate is 3.5%. My IRA earns 7% on average. Why would I pay off a 3.5% debt when I could leave that money invested earning 7%? The math favors keeping the mortgage. That argument is correct for a working person. It is wrong for a retiree. And the reason it is wrong is that it ignores 3 things that only apply after you stop working. The first thing it ignores is the tax cost of the IRA withdrawal required to service the mortgage. A working person paying a mortgage uses after-tax earned income to make the payment. A retiree paying a mortgage uses pre-tax IRA distributions to make the payment. Every dollar withdrawn from a traditional IRA to pay the mortgage is a dollar of taxable income. At a 22% marginal rate, a $100 monthly mortgage payment actually costs the retiree $1,408 per month in pre-tax IRA dollars because they have to withdraw $1,408 to net $1,100 after tax. The effective interest rate on that mortgage, when you account for the tax cost of the withdrawal, is not 3.5%. It is closer to 4.5 to 5%. Which narrows the gap with the IRA's investment return significantly. The second thing it ignores is the Social Security taxation effect I described in Part 3. The additional IRA withdrawal required to cover the mortgage payment pushes provisional income higher, which can move a retiree from zero Social Security taxation to 50% taxation, or from 50% to 85%. That is an additional hidden cost of the mortgage that the simple rate comparison does not capture. The third thing it ignores is sequence of returns risk. The argument assumes the IRA earns 7% per year. But in retirement, you are withdrawing from the IRA simultaneously as it experiences market fluctuations. If the market drops 25% in year 2 of retirement, as it did in 2022, and you are simultaneously withdrawing $18,000 per year to cover your mortgage payment, you are selling shares at depressed prices to service a debt. That permanent reduction in share count compounds against you for the rest of retirement. The mortgage payment is fixed. The IRA's ability to recover is not. When you account for the tax cost of the withdrawal, the Social Security taxation effect, and sequence of returns risk, the case for keeping a low-rate mortgage in retirement collapses in the majority of real-world retiree scenarios. The math that favors the mortgage is working capital math. It does not apply to retirement income math. Almost no retiree has been told the difference. Almost no financial advisor has run the full calculation that includes all three factors. And the ones who have run it reach the same conclusion that 30 years in finance brought me to. For the median American retiree, paying off the house before retirement is the highest return financial decision they can make. Not because real estate is a great investment, but because eliminating the mortgage payment eliminates the IRA withdrawal that triggers the entire tax and Medicare cascade. To make this real, let me tell you about a retired teacher named Margaret. Margaret is 71 years old. She lives in Scottsdale, Arizona. She taught high school English for 32 years in the Phoenix School District and retired at age 64 with a state pension of $2,200 per month and a traditional IRA she had funded through her husband's 401k before he passed in 2019. The IRA balance when she retired was $410,000. When Margaret retired in 2019, she had 7 years left on her mortgage. The remaining balance was $94,000. Her monthly payment was $1,040. Her financial advisor at the time, a competent, well-meaning professional, told her to keep the mortgage. The interest rate was 3.8%. Her IRA was earning better than that in a balanced portfolio. The math favored keeping the mortgage. He ran the numbers on a spreadsheet and showed her the projection. What he did not run was the Social Security and IRMAA calculation. Margaret's annual income in retirement was $26,400 from the pension, $18,600 from Social Security, and $14,400 in IRA distributions she needed to cover expenses, including the mortgage payment. Total income, $59,400. Her provisional income, $4,800 in non-Social Security income plus $9,300, which is half of Social Security, was $50,100, well above the $34,000 threshold. 85% of her Social Security was taxable. Her total federal income tax bill in 2020, $4,100. Her Medicare premiums were at the base rate that year because her 2018 income, her last working year, had been higher and her retired income happened to fall below the IRMA threshold. But in 2023, based on her 2021 income, which was $59,400 again, the Social Security Administration reviewed her IRMA status and determined she owed the first-tier surcharge. Her Medicare Part B premium jumped from $170 per month to $238 per month. Part D added another $12 per month. Extra Medicare cost per year, $816. By the time Margaret's mortgage was paid off in mid-2026, 7 years into retirement, she had paid approximately $28,700 in federal income taxes she would not have paid without the mortgage-driven IRA withdrawals. She had paid an additional $4,080 in excess Medicare premiums from the IRMAA surcharge. Total hidden cost of keeping the mortgage, approximately $32,780, on top of the $72,800 in mortgage payments themselves. Margaret called me after watching a video on provisional income in late 2025. We spent an hour on the phone going through her numbers. She was quiet for a long time after I walked her through the calculation. Then she said, Nobody ever showed me that. Nobody ever put those numbers next to each other. That is the point of this video. To put the numbers next to each other while you still have time to act on them. Now let me walk you through who this applies to and who it does not, because this is not a universal prescription. There are specific situations where carrying a mortgage into retirement is the correct financial decision. This applies to you if you have a traditional IRA or 401k as your primary retirement account, because the tax cost of the withdrawal is central to the analysis. If your primary retirement income is from a Roth IRA, the calculation changes significantly because Roth distributions are not included in provisional income. This applies to you if your total retirement income, including the IRA withdrawals needed to cover a mortgage payment, puts you within $25,000 of the IRMAA threshold. The closer you are to that threshold, the more powerful the mortgage payoff becomes. This applies to you if you are within 10 years of retirement and still have a meaningful mortgage balance. The further from retirement you are, the more time you have to make additional principal payments and reduce or eliminate the balance before your income drops to retirement levels. This does not apply cleanly if you are already in retirement with less than 5 years remaining on your mortgage and a low remaining balance. In that scenario, the total remaining interest cost may be modest enough that the payoff does not meaningfully change your income picture. Run the calculation with your actual numbers. This does not apply if paying off the mortgage would require liquidating taxable investment accounts and triggering large capital gains. In that scenario, the tax cost of the payoff may exceed the tax savings from eliminating the mortgage-driven IRA withdrawals. The analysis must be done with your specific account mix, not a generic formula. This does not apply if you have a Roth IRA large enough to fund retirement expenses without triggering provisional income. In that scenario, the mortgage payment can potentially be funded from Roth distributions without affecting Social Security taxability or IRMAA status, though you still face sequence of returns risk from the mandatory withdrawals. The core rule is this: if carrying a mortgage into retirement forces you to withdraw more from a traditional IRA than you would otherwise need to withdraw, and if that additional withdrawal pushes your provisional income above a Social Security taxation threshold or an IRMAA threshold, the financial case for paying off the house before retirement is almost always stronger than the financial case for keeping the mortgage and leaving the money invested. Almost no retiree has been told this. Almost no financial advisor has run this specific calculation for a client sitting 10 years from retirement. Here are the 5 protection moves every retiree or near retiree needs to take right now. Protection move number 1. Calculate your retirement provisional income today with the mortgage and without it. Take your expected Social Security benefit, your pension income if any, and the IRA withdrawals you will need to cover your expenses at both income levels. Apply the provisional income formula, AGI plus non-taxable interest plus half of Social Security. Compare that number to the $25,000, $34,000, $103,000, and $206,000 thresholds. Where you land determines how much the mortgage costs you in hidden tax and Medicare expenses. Protection move number 2. Call your mortgage servicer and request a payoff quote and an amortization schedule showing your remaining principal balance by year. You need to know how much it would cost to pay off the mortgage completely and how long you have until the balance drops to a level where the tax savings of eliminating it outweigh the cost of liquidating assets to do so. Protection move number 3. Review your IRA and investment account mix. If you have both traditional IRA funds and taxable brokerage funds, there may be a tax-efficient way to use the brokerage funds to pay down the mortgage without triggering a large taxable event. Consult a CPA or enrolled agent who specializes in pre-retirement tax planning before liquidating any account. Protection move number 4. If you are within 5 years of retirement and your mortgage balance is under $150,000, model the scenario where you make an additional principal payment of $500 to $1,000 per month beginning today. At that rate, a $120,000 balance can be eliminated in 8 to 10 years, potentially before or immediately after retirement. The monthly cash flow freed by eliminating the payment can fund the additional principal payments with minimal lifestyle change. Protection move number 5. Ask your financial advisor directly and specifically, have you run a calculation showing the impact of my mortgage on my projected provisional income, Social Security taxation rate, and IRS status in retirement? If the answer is no, ask them to run it now. If they cannot run it, find someone who can. The calculation is not complicated. It takes under an hour with the right inputs, and it may be the most valuable financial analysis you have done in the last decade. Now let me share one bonus move that most retirees with a mortgage have never considered, and that almost no financial advisor mentions. It is the 72T distribution strategy paired with an aggressive pre-retirement mortgage paydown. If you are between ages 55 and 59 and a half, and you want to access your IRA to pay down your mortgage before retirement without paying the 10% early withdrawal penalty, IRS Section 72T allows you to take substantially equal periodic payments, called SEPs, from your IRA without the penalty, provided the payments continue for at least 5 years or until age 59 and a half, whichever is longer. The 72T election is irrevocable once started, and the payment amount is fixed by one of 3 IRS-approved calculation methods: the required minimum distribution method, the fixed amortization method, or the fixed annuitization method. The fixed amortization method typically produces the highest annual payment and can be used to generate a predictable annual IRA distribution that is directed entirely toward mortgage principal reduction. A retiree who initiates a 72T election at age 56 with a $300,000 IRA and uses the fixed amortization method may generate annual payments of $15,000 to $18,000, depending on the applicable federal interest rate. Directed entirely toward mortgage principal over 5 years, those payments can eliminate $75,000 to $90,000 in mortgage balance, potentially clearing the mortgage entirely before retirement. The distributions are taxable, but they are taken while the person is still working and presumably in a higher bracket, which sounds counterintuitive. The reason it still works is that the income from the 72T distribution, added to working income, may still produce a lower total lifetime tax bill than the alternative, retiring with the mortgage, forcing elevated IRA withdrawals for 15 years, and paying both higher income taxes and IRS surcharges throughout retirement. Almost no retiree under 60 has been told this strategy exists. It is not for everyone. It requires precise calculation and a commitment to the payment schedule. But for a retiree on the right side of the qualification window, it is one of the most powerful pre-retirement mortgage paydown tools in the entire tax code.